Hello, everyone, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Spring 2021 Not-for-Profit Tax Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters, Colleen Ramires and Emina Cresswell, both tax senior managers at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Emina to get the presentation started.
Thank you, Amy. Hello to everyone. We've got quite the lineup for you this morning, at least on the West Coast. With today's topics, updates from the IRS and the Treasury, what's happening on the Capitol Hill, some recent rulings and updates, and then our hot topics is the state tax considerations and COVID-19. Been a lot going on these past few months, year and a half, so there's a lot to cover. We'll try to cover as much as we can in this brief 1-hour session that we do have, so we'll just dive right in. All right, some updates. What's happening with the IRS and the Treasury? So quite a few updates with regards to e-filing and requirements for starting this year and also last year. The Form 1023, which is the tax-exempt application for IRS determination to be a tax-exempt, is Form 1023 EZ are now required to be electronically submitted on the IRS website. Historically, you were able to do it online and just type in, PDF and then kind of go after that and submit it via paper. Now it's electronically. The Form 1024 EZ, as of April, is also now due online. Form 990 and the 990 PF is required to be e-filed for tax years starting after July 2019. And there are just very, very few exceptions with regards to when you can. Oh, hold on. Looks like we've got some microphone issues, so we're just going to. Hopefully this is better. So just bear with us as microphone issues. All right, so Form 990 and 990 PF is also required to be e-filed now with regards to Form 990 2020. And then the 990 EZ, which is the smaller form, is required to be e-filed for tax years beginning after July 31st, 2021. So there is a little bit of a break for those smaller organizations to be able to e-file their tax returns. New this year for 2020 tax filings is the Form 4720 for 990 PF filers, along with the Form 990T for tax years 2020. A few caveats here and there with regards to the 990T is that there's only just a few limited software vendors that are able to actually electronically submit these tax returns. The IRS does have on their website a list of those vendors that are able to do that for you. So just a quick update on requirements, and they might be able to also send you a little little notice saying, hey, just an FYI, you're required to be e-filed. So just a friendly reminder there. All right, well, as we all know, I'm sure that the IRS is still quite backlogged in processing tax returns and IRS letters and notices. They are, last time we heard back from them is they're still processing items that were even mailed by last July. So almost a year behind. They're doing the best that they can at this point with limited capacity and slowly starting to add more capacity as they navigate through all the new changes in law and various different forms. As of March 1st, 2021, the IRS has received about 23,436 applications for just tax-exempt status. That's quite a few applications just as of March 2021. So you can probably imagine there's quite a few in the backlog. So we'll talk about the backlog for the IRS tax-exempt applications shortly. So here's what the current inventory turnover looks like. The average is about 106 days for the IRS once they receive your tax-exempt application to the time that they end up processing or really going through the details. It's 86 days for the Form 1023, 134 days for the actual 1023 application, which is the much larger application process, 157 days for the Form 1024. The Form 1024 is for all other tax-exempt organizations that are non-501c3s. And then the 123 days for the 1024 EZ application. So you can kind of see that it's taking them quite a bit of time to get through their backlog. And 147 days is for Form 8940, which is the form that you would use if you had any other miscellaneous determination applications, such as switching from a different type of tax-exempt filer to another tax-exempt filer, such as becoming a supporting organization of another 501c3 organization, as an example. And then, as you would imagine, the number of applications that have been in review over 250 days, which seems quite a bit, has increased just a little, about 1.5%. So the IRS, as you can imagine, is quite backlogged, but they are doing the best that they can. So if you have submitted your application, that's kind of where things stand, and that's about the average time frame that we're looking at. All right. At this point, we're at our first polling question out of 4. So Amy, I'm going to turn it over to you for our first polling question.
All right, so the question is, do you currently have an application pending with the IRS? A, yes, or B, no? And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit submit. If you cannot see the submit button, you may need to enlarge the slide area so that you can see it. And then also just a reminder that if you would like to receive CPE credit, you do need to respond to at least 3 of the 4 polling questions.
Like we're getting very close.
And it looks like most have responded, so here are the results.
Majority, no, as we suspected. But something to keep in mind is it's not just the IRS applications for determinations that are backlogged. It's also any sort of notices, them not finding your payments received, and then responding back to them. So it's just any kind of correspondence. They are quite behind, and even processing tax returns, they're still quite behind. So keep that in mind. All right. Moving along and switching gears as to what is happening within the IRS and what's going on. They are restructuring, kind of some small internal restructuring, which is typical for the IRS to do anytime there's new leadership. They think about, how can we make the experience better, and how can we have a better flow of data between, the administration and the taxpayer, and how can we make it more collaborative. And so the areas of focus for this year is just the taxpayer experience. And when you call the IRS, the agents and how they interact with the taxpayers, and even professionals when they call, how's that experience? And employee training and getting them up to speed on quite a few tax law changes. It felt like the last several years have just been constant change, and so there's a lot for their employees to learn. So a lot of training, and then address the current and future needs of taxpayers and administration. So kind of more of a looking forward approach and seeing, how can we make this more efficient on a going forward basis and not really look back, and expanding the digital information platform and outreach to the public. So making information more easier accessible, restructuring their website. If you've kind of looked at their website, it's been recently redone a little bit and restructured a little bit, so it's a little bit easier to see, find information, and then of course the expanded digital information platform is a welcomed item, at least from a tax practitioner side, is enabling it to have a bit more free flow of data. So I'll cover that briefly too, as to kind of what are they doing from an expanded digital platform. They continue to use digital signatures, which is a welcome item, especially on IRS exams. They've enabled this new secure messaging platform between IRS exam agents and taxpayers and their representatives. At this point in time, this platform is voluntary, but it is a secure platform whereby you can exchange the data. Historically, it used to be you either fax it or you mail it, and now with everyone being remote and the IRS, operating remote too, they have switched it up to be able to now do a lot more of this secure messaging, which is a welcome item for sure. The program letter is updated now quarterly. It used to be done on a yearly basis, and now is a much smaller program letter. The program letter is really just an area of focus, what the IRS is focusing on for this go around, and what are some common issues that they're seeing and areas that they're looking at when it comes to IRS exams. The statistics down below, the closed of 1,000 exams in fiscal year 2021 was as of essentially March, with an 86% change rate, meaning that 86% of those cases turned into some sort of changes to the Form 990, 990T, and other related forms that the IRS agents were looking into. So a pretty large amount, and this was just cases as of early this year, so we can probably expect more cases to be throughout the year. So what are some areas that they are focusing on when it comes to IRS exams, and what are they looking at? Kind of your common typical ones that we've seen over the years with regards to private foundations and self-dealing issues, private inurement and benefits, I would say unrelated business income and worker classification, W-2 versus Form 1099, have always been hot topics, but the newer items is the excise taxes on the excess compensation, hospitals under the Affordable Care Act. That has always been a hot topic ever since probably at least 10 to 12 years ago, and then underreported compensation and related employees and for-profit partnerships. So kind of looking at the different relationships, compensation, unrelated business income, UBI, and worker classification have been hot topics ever since I've been in public accounting. So pretty common areas, but those are kind of the areas that they're still focusing on. All right, switching a little bit of gears is the Treasury Update. There has been a lot of COVID relief legislation issued. We'll cover just a few of those items later today. Colleen will go over that. And then the guidance is ever evolving and more is coming on a consistent basis with regards to, and for instance, this employee retention tax credit. There's a lot of questions now that PPP loan forgiveness, that many organizations are applying for it. Do you include it in gross receipts as defined by IRC Section 6033? The IRS says, well, guidance is coming, and that was as of March, that was as of April, and we still have not seen entirely guidance coming out yet. So it's taking them a little bit of time, and it's ever changing. So, we'll keep you in the loop as anything happens, but at this point in time, more guidance is coming. But so be on the lookout. It's ever evolving. Okay. Speaking of employee retention tax credits, the new revamped Form 5884D is coming out with regards to employment tax credits. And then the employee retention tax credit has been extended until December 31st, 2021. But the CARES Act extended until June 30th, 2021. And after that, the IRS, what they've done is, not the IRS, but the Congress, I should say, and then IRS has implemented the new code section, replaces it through the rest of the year. So there's the difference between the two types of, well, they're the same credit, they're just slightly different computations, is how to compute qualifying employees. That's the biggest difference between the two. So keep that in mind. They are two credits still available to the rest of the year. They're just slight differences between the two. So we'll cover employee tax credits just a little bit. All right, the other hot topic that the IRS and everyone else has kind of been, it's been in the news, and hot topic is the IRC 4960, which is essentially the excise tax on excess compensation over $1 million, or the excess parachute payments to covered employees. The excess parachute payments are essentially severance payments when someone leaves the organization. It's 3 times the amount of what their compensation has been over the last average of 5 years. That's typically the computation, but there's more to that than just this little blip. The final regulations were issued as of January 2021, so just a few months ago, and the final regulations basically said there's still some areas that we need to address, such as federal instrumentalities. So our federal chartered credit unions, for example, there's still uncertainty as to, hey, should this be, should this not be, and there's just a lot of other federal instrumentalities where there are some uncertainties, and then foreign organizations that the IRS is looking for feedback and addressing, or still looking at it to see what kind of guidance they still need to issue. So while we have final regulations, there's still a lot more out there that needs to be addressed. So we are looking into it and monitoring it and hopefully getting some guidance soon. All right, our second polling question. Amy?
All right, thank you. So our second question is, do you think the excise tax on excess compensation will apply to your organization? A, yes, B, no, C, maybe, or D, I'm just here for the CPE. And then also, if you do have questions for the presenters, please submit them using the Q&A window in your console. We do have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. And it looks like most have submitted, so here are the results.
Most is no, as expected, and some are maybe. So great. Good information. All for submitting. All right, we're going to switch gears and talk about, what is Capitol Hill thinking? What's our Congress thinking? What's happening? Are there changes possibly happening? And what is their focus areas this go around? Another hot topic that the IRS and Congress has looked at is the endowment tax on colleges and universities at a 1.4% tax rate on net investment income. Typically, what you see is those larger universities that have large endowments that are affected by this. And what it comes down to is what are some permissible uses of the funds and what is exempt purpose use? That is an area that they are still looking at and hope to have some sort of clarification for everyone else. Syndicated conservation easements has been a hot topic and always a discussion, and an area of focus as to what can be charitable deduction, what shouldn't be a charitable deduction, can they even be a charitable deduction? So taking a charitable deduction as 2 times the investment in the partnership in this case is what they're really looking at, and trying to assess, should they just completely disallow it at this point? There was a bill introduced in Congress back in December that denies a deduction for conservation easement charitable deductions, but it hasn't really progressed much at this point. So more to come on that. They've also clarified that charitable deduction timing for the enhanced thresholds for trusts are based on calendar year payments for fiscal year filers, which means a lot of what has happened with the CARES Act and other acts as part of COVID is they've increased the thresholds for individuals, for trusts, with regards to how much they can deduct on a taxable income type threshold. And so the payments, if they are during the calendar year, you might have a situation where for a fiscal year filer, you may have kind of 2 different rates that you might need to use on the tax return. So they've clarified that it's based upon calendar year payment dates versus the tax year that you're filing as your fiscal filer. So keep that in mind. All right, and then the next area is like I said, the 4960, which is the excise tax on excess compensation. That area will likely stay. I know there's been a lot of pushback on that from the public and a pretty big outcry with regards to it being unfair. The Congress position is that it was enacted to make it fair between taxable and tax-exempt organizations, whereas tax-level organizations have limitations as well if there has been excess compensation. They just call it slightly different, a slightly different tax code, but what they really try to do is just make it fair between the 2 types of entities that could exist. And then the UBI bucketing, that is part of the Tax Cuts Jobs Act. It might be modified, but it hasn't received as much attention as the other TCJA additions. So there is a possibility that this could be modified, but it's a pretty slight chance. And then donor-advised funds have been on the Capitol Hill list and a focus area for quite some time. And what they're looking at here is that they are time-limited DAFs, so donor-advised funds, or payout rates. So some restrictions with regards to donations being given out or having some sort of payout rate whereby, the donor gives to a donor-advised fund, the donor-advised fund just sits there and doesn't get actually distributed out to the community or, a charitable organization that could benefit from those funds. So they're looking at having it either a time limit or some sort of payout rate structure in there. But definitely more to come on that. There hasn't been as much movement, and so we'll see what happens there. And then last but not least, voting and election integrity along with dark money. And that's always just been on their list and making sure that voting and election integrity remains intact and where money is coming from. So those are kind of just a few areas that Capitol Hill is looking at, and definitely more to come. We're monitoring all sorts of progress and bills as they come along that could affect this sector, and we'll see what happens. Ever-changing, ever-evolving world that we live in. So, all right, and just a brief touch on recent rulings and updates as to what has happened, what has IRS ruled on, and what are they looking at. So they have looked at marijuana activities. More and more states are making it legal now. So they wanted to make sure and clarify that under federal law, it is still not a legal activity, and therefore marijuana activities could jeopardize the tax-exempt status. Another area that they are also looking at and ruling on is too much public income or investment income for social clubs. Think of it as your country clubs, for example, your tennis clubs, things like that, where they may have too much non-member income or investment income as compared to their member income. And then private letter rulings regarding interactions when you have organizations that are related and they're 501c3s, 501c4s, and PAC activities or political action committee activities, and how that interacts for the tax-exempt status for a 501c3 organization that might be related and has PAC activities. As some of you may know, 501c3s are pretty much prohibited from having and doing any sort of political activities, and therefore how does that interact when they are related organizations and one of them is doing PAC activities and the other one is not? So there has been a private letter ruling about that, and so that's been interesting to see and review. And another item that they are looking at as well, and there seems to be disagreements between the IRS and the different courts and with regards to board member fiduciary duties. So kind of interesting to see how each different district views things and what board members are responsible for and what sort of duties they are looked at. So kind of interesting to see those sorts of rulings and updates, and of course private letter rulings are very specific to the individual tax-exempt organization that is requesting that. So it's more of a guide as to here's what the IRS is sort of thinking, but not necessarily fully reliable as it's really specific to that organization. So kind of keep that in mind. All right, with that, we're on to state tax considerations. So I'm going to hand it over to Colleen.
Thanks, Emina. So we're going to go over two kind of main state tax considerations that have kind of become more of a kind of deal over the last year or so. And so the first one that we're going to cover is what's commonly referred to as just Wayfair. And this relates to sales tax with different states. So in 2018, there was a Supreme Court ruling, South Dakota versus Wayfair. South Dakota had enacted essentially what's considered an economic nexus. So if an organization had 200 transactions or 100,000 in state sales, they were subject to sales tax in South Dakota. Before this case, there was the Quill versus North Dakota case, and in that, the Supreme Court ruled the opposite, where a seller has to have a physical presence in order to be to have nexus, and essentially nexus means that you're subject to that state's either sales tax or income tax or whatnot. So this was a pretty big change, and it essentially created an economic nexus standard whereby if you have sales into a certain state, even if you have no employees, if you have no physical building or other items that can create physical presence, you could still be subject to that state's sales tax. So of course, after this court case was ruled in South Dakota's favor, lots of states jumped on the bandwagon. They saw this as an opportunity to have, consider to have more revenue be applicable or be subject to their state sales tax, thus generating more revenue. With the nexus, there usually is a threshold that an organization must meet before that state's sales tax is applicable. There's generally either one or a combination of number of transactions or amount of sales. So I had mentioned for South Dakota, if you either had 200 transactions or more, or if you had 100,000 or more of sales, you tripped one of those, then you became subject to their sales tax. Thresholds vary by states, as is usually the case in every way. States are different and they pass their own laws, and so they're able to do kind of their own thing, and so you have to pay attention to what each state's requirements are. In general, though, we typically see 100,000 of sales or 200 transactions or more is what is the most common. But again, you can have states that have less than this or more than this, and it can be if you meet either of these, or it can be a one or another. So the question is, well, how does this affect tax-exempt organizations? A lot of states don't have blanket exemptions for tax-exempt organizations when it comes to their sales tax. A lot have kind of blanket exemptions for any income, their state income tax outside of usually unrelated business income is subject to that corporate income tax. However, not usually for sales tax. So this could be applicable to a tax-exempt organization. Where we're seeing this kind of be a thing where it really needs to be a consideration is website sales. In the past, you were located in state A and you were selling to state B. Because you were located in A, all of those website sales were applicable to the state A's, sales tax rules. Well, now after the Wayfair case, any sales to state B could be subject to state B's sales tax. Again, you also have to consider the threshold. So it may be that your website sales aren't at the level where it becomes, you've triggered economic nexus. But still, it's something to be aware of. It's important to be able to track or support kind of where the sales are coming from or where the sales are to verify that there isn't any implications of having to withhold sales tax or file in that other state. There are common exceptions that a lot of states have. So contributions, fundraising events usually we see are not subject to sales tax. There are occasionally some specific types of organizations. So you're doing a specific type of charitable activity or like churches, for example. Most states have a kind of blanket exemption for churches. Not all of them. Again, this is a state-by-state basis, and all their rules differ. And then one thing to note, so if you haven't triggered economic nexus in another state, and thus you're not, those sales aren't subject to that state sales tax, it could still kind of come back to the home state. So in that A, B, it could come back to state A and be subject to the sales tax rules in state A. So just because it's, we've kind of got this economic where sales are going to focus, that doesn't mean that it can't come back and be subject to the states where there's a physical presence. And then another important state consideration that has really kind of blown up over the last year is remote work. With COVID-19, with shutdowns in most states, a lot of employees have had to begin working remotely, have been working from home. With that, when you're working remotely, when you're not having to physically be in an office, you can essentially work anywhere as long as you can, access the internet and be able to do your work from that location. Well, with that brings a lot of considerations. That brings state considerations, that brings foreign considerations, things where it may seem fairly easy to just pick up, go to another state, go, overseas and start working because you can still do your job similar to how you were doing it when you were working from home in that state. However, that opens up a lot of requirements that the employer is going to need to know about. So with that, it's really important to have policies and internal controls around remote work, making sure there's requirements that employees let you know if they're going to work remotely, let you know if it's a temporary period, let you know if it's going to be a permanent period. Because as an employer, you need to be aware of these. the state somehow figures out that you've got an employee working in that state and you're not registered or paying payroll taxes and whatnot, they're going to come talk to you as the employer, not necessarily or not just to the individuals. There's also, especially with foreign, there's security risks that need to be considered before that remote work is allowed. So one of the main considerations with remote workers is income tax. There's only 8 states that don't have an individual income tax. And once you have an employee working in a state, that becomes their tax home, they are likely subject to that state's income tax. With that, then you've got registering with the state requirements. You're going to need to start withholding for that state tax, and then you likely also have new reporting requirements, payroll reports that you'll have to file for that state. So when you look at this, if you think, let's say you just have 5 employees, but they're working in 5 different states, you now have 5 other states you have to register with, 5 other states you have to consider withholding, 5, additional payroll reporting that you have to do, where that could be 1, 2, 3. It increases the administrative. It can increase the administrative work quite a lot very quickly. There are some exceptions with remote workers. These first 2, generally we see these for more temporary remote work assignments. We're not seeing it so much where I've, worked out an agreement with my employer where I'm going to go to another state, and that is where I am now going to be working because we figured out that this remote, arrangement works really well. So the first exception is the reciprocal agreement between states. So you may have state A that has an agreement with state B, and their agreement is state A can have an employee go work in state B, and state B is not going to make that employee subject to their income tax, payroll tax, whatnot. That employee will still be considered as if their tax home was under state A. Again, as per most of this stuff, there isn't reciprocal agreements with all states. Sometimes there's one-on-one, and there's different. So state A may have one agreement with state B and a different agreement with state C. Some states don't have any reciprocal agreements. And like I mentioned, some of these are for only short periods of time. If you have somebody that's going to that state permanently, that state's probably going to be like, well, no, now they need to be subject to our payroll taxes and whatnot. There's also a de minimis threshold. This very much relates to temporary. So if you have an employee that's going to work in another state for a week or a couple days, if they meet that state's de minimis threshold, again, they're not subject to that state's payroll registration tax requirements. There are some states that do not have a de minimis threshold. So for those states, if you send an employee, if you have an employee working remotely for a day, technically you are now subject to the payroll taxes and registration requirements in that state. Now, obviously with that, you kind of need to do a cost-benefit risk analysis, having to register and file all of those for one day of an employee working in that state. There's just some of that consideration to think through. And then some states, not all, but some states have put in COVID-19 exceptions because, this is something that's affected the entire country, the entire world, and they realize that, this may be temporary and that there's some unexpected effects to organizations kind of with this change. There could be, you have an employee that goes to another state for a month or two because they need to care for a family member. There could be exceptions under that. Some other things to consider, unemployment insurance. Does your employee now fall under that state's unemployment insurance requirements? And then other considerations outside of just the payroll tax aspect of it. Sales and use tax. We just talked about Wayfair and creating economic nexus. Well, if you have an employee in another state, you likely have now established physical nexus. So if you have sales coming from that state and you don't meet the economic nexus threshold, since you've just established physical presence, that could now, those sales could now be subject to that state's sales and use tax. Also, we've got entity-level income and franchise tax considerations. If you have, like I had mentioned, most tax-exempt orgs are exempt from income tax at the state level outside of unrelated business income. Most states, if you have federal taxable income, it's also going to be subject to the state's taxable income. If you have an employee in that state, you've now created nexus, physical nexus. So now you need to look at, is there a requirement to potentially, as part of your unrelated business income, subject to that state's income or franchise tax. There's also workers' compensation insurance considerations. Secretary of State registration, again, you've created nexus, so you could be considered a foreign business, foreign meaning from another state, that's now doing business in that state. So you may need to register as a foreign business with that state, with the Secretary of State. Also, there could be local tax compliance. So the city that your employee is located in, there could be state, or they could be local payroll tax or local sales and use tax, in addition to the state tax considerations. One thing that I've seen kind of come up, a specific example, is a business that's organized and operates outside of California, has an employee that decides they're going to move to California and work there remotely. Well, in California, you've now established physical nexus. Well, in California, you have to apply separately for exemption in that state. So even if you have federal tax exemption, which for a lot of states means you have that federal tax exemption, you're good with the state, you're exempt outside of unrelated business income. In California, that's not the case. You have to file a separate application with the state. You do not, you are considered a taxable organization. So one example of where it's important to know the rules from the state, otherwise you could get yourself into a bit of a mess. Also with California, they're one of the states that do have a separate kind of 990 equivalent filing for that state. So if you're in California and don't have any unrelated business income, you could still have filing requirements. And then international, I'm not going to go too much detail into this because it is very nuanced and very technical. There's a link to one of our articles at the bottom of this slide that goes into more detail. And we definitely, if you have employees that are wanting to work internationally remotely, we definitely have professionals that this is their area, and we can definitely get you connected to make sure that you're considering everything that you need to. So it's important, though, to determine if there's a risk of establishing a taxable presence in that country, understand the country's employee versus contractor distinctions, consider if there's any withholding taxes that may need to be done, and also there could still be U.S. reporting requirements even if they're working remotely internationally. And with that, I am going to turn it over to Amy for our third polling question.
All right, thank you. So our third question, which applies or may apply to your organization? A, sales tax economic nexus. B, out-of-state or country remote workers. C, both, or D, neither. And then also for those of you that would like a copy of today's slides, you can download them now from the folder that says slide deck and handout. We will also be sending the slides via email tomorrow along with a recording of this webcast. All right, most have responded, so here are the results.
Okay, so we've got quite a mix. It looks like outside of those that say neither of these are applicable, out-of-state country remote workers is the next highest thing that will apply. And again, that's not surprising. This is pretty much, remote work is here to stay at some level. You know, with things starting to open back up, we are seeing kind of people return to the office, but there are employers and there are individuals that the remote work worked well for them. They like the flexibility of it. And so a part of it is here to stay, and definitely considerations that need to be made. All right, and so with that, you can't really do a webinar these days without talking about COVID-19 legislation. We're going to cover some of the updates from recent legislation. This is going to be high level. Some of the individual things that we're going to cover, you can, and we have spent an entire hour talking about it. So this is going to be high level. We have links at the end to our online content that provides more information. And as always, feel free to reach out to get more specific questions answered. So this is the long list of relief legislation that has been passed over the over a year. The two legislations in red at the bottom, these are the two that we're going to cover the updates from. So it's a Consolidated Appropriations Act is what that should say. That was enacted in December. And then the American Rescue Plan Act that was enacted just a couple months ago in March. So some of the recent relief legislation updates. So employer retention tax credit, there was an extension, expansion, and modification. Same with the family paid sick and family leave that was passed under the Family First Act earlier last year around this time. There's a new COBRA subsidy. There's also the Shuttered Venues Operator Grants. There's also, for organizations that have self-insured unemployment, there's a reimbursement of that was enacted with the CARES Act. It was 50% reimbursement of those unemployment payments that were made, and that was through the end of last year, 12/31/2020. The extension that was done through the American Recovery Act it's increased it to 75% reimbursement, and that is from April, it's 10th or 11th, depending on the state's unemployment unemployment week ends, and it goes until September 4th or 5th. We're generally seeing that this is coming through the states. It's coming from the Fed to the states, and we're seeing most states are just automatically reimbursing, and there isn't, you don't have to apply for it to get that reimbursement. Charitable giving incentives were extended, so 100% for individuals. Corporations went from 10% up to 25%. I do want to just point out that the increase in the corporate charitable giving does not apply to unrelated business income. The way that they structured the legislation and the way that the IRC is structured doesn't line up, and so it is not subject to unrelated business income where where corporate tax law comes into play. Also, we're not going to cover it, but there was an extension of the PPP loans, an expansion of it. So there was the second round, and then clarification. For the clarification, so the IRS originally came out and said that any expenses that were funded with PPP funds, you couldn't take them as a tax deduction. Congress in their legislation reversed that so you can, and that would be applicable in cases of unrelated business income. Also not covered here, there's specific relief that was passed for healthcare organizations, higher education, and tribal organizations. Again, I'm going to refer you back to our website that has lots of great content, lots of great webinars that cover these. There was also some qualified disaster relief provisions that are related to non-COVID disaster assistance. We're not going to cover that, but that is there. All right, so we're running short on time, so we're going to kind of go through this very high level. You have the slides. Again, feel free to reach out or go to our website where we've got additional content. So one of the main things that was changed with the ERTC is that it opened up organizations that had received PPP loan funds, and it made it retroactive. So before, if you received PPP funds, you could not take the ERTC. Now it is available if you meet the other qualifications, and it's retroactive back to the date that these were enacted. Also, for certain government organizations, they are eligible, or it's available to them as of January 1st, 2021. Those mainly we're seeing are colleges, universities, organizations that are providing medical or hospital care. The credit was also extended through the end of the year, December 31st, 2021, and there were modifications made to the credit, which we'll cover very high level. So the ERTC is applicable for 2020. You'll see these amounts that are in, or these items that are in red. These are items that have changed and are different between 2020 and 2021. So 2020, a credit of 50% up to $10,000 of qualified wages. So the credit was up to $5,000 per employee for the year. To qualify, you either had to be subject to a government suspension of operations, that's full or that's partial, or 50% year over year, comparing to 2019, decrease in gross receipts for that quarter. So you looked at a qualified employer quarter by quarter basis. And then qualified wages, if you had under 100 full-time employees, all employee wages counted regardless of whether services were performed or not. If you had more than 100 full-time employees, and you're looking at 2019 averaged for this, wages that are paid to employees who are not providing services are qualified wages. So if you had an individual that wasn't working but you were still compensating them, then those wages would be qualified if you had more than 100 full-time employees. Also, qualified health plan expenses are considered qualified wages. So if you had people on furlough and you continued to pay their health plan premiums, those would be qualified wages, assuming you're a qualified employer, you know, and these other items are applicable. So then for 2021, we've highlighted the changes. It's 70% of $14,000 of qualified wages, up to $9,800 of credit per employee per quarter. Previously, it was per year. They changed it, so it's now per quarter. Also, the decrease in gross receipts is 20% when compared to 2018 versus the 50%. And then for qualified wages, we're looking at 500 full-time employees for that all wages versus wages provided when not providing services. And I do want to just mention the full-time employees are employees that provided 30 hours or more of service. We're not looking at full-time equivalents. So if you have employees that worked under 30 hours average in 2018, you do not need to be considering them in this 500 full-time employee count. Also, it's important to know that affiliation rules do apply for related organizations, and that can affect your employee count, and it could also affect your gross receipts. Affiliation rules are pretty nuanced, so you kind of want to just get information specific to your fact pattern. And then some other credits, so the paid sick and family leave credits, those were extended as well. Those are applicable to organizations that have under 500 full-time and part-time employees. That's kind of one of the things with all this legislation is full-time employees or, you know, applicable employees is not the same for everything. So it's a refundable credit against the Social Security, their wage or taxes. There are some limitations that apply. It was extended through September 30th, 2021. It now includes leave for vaccinations or if somebody can't work because they're waiting for test results. It also provided 2 additional weeks for family leave. Another credit that's come into play is COBRA subsidy. Employers that are required to provide COBRA are now required to pay the COBRA for employees that were terminated involuntarily or had their hours reduced involuntarily. This is 100% subsidy, so it covers all of the costs of what you're paying. It's a credit on Medicare taxes versus Social Security, and it is applicable from April 1st to September 31st, 2021. And then finally, we've got the Shuttered Venue Operator Grant. This has been in place for a little while. Hopefully, if this is applicable to you, you have already submitted your application online. Some eligible operations, this is not all inclusive, but I just try to cover those that would probably be more applicable to this group. Theatrical producers or production companies, live performing arts organizations, and relevant museums. And then other eligibility requirements, you had to have been fully in operations as of February 29th, 2020. Decline in gross receipts earned revenue or gross earned revenue needs to be 25% from any quarter in 2020 when you compare it to 2018. And there needs to be an intention to reopen. There are certain limitations for organizations that received PPP loan funds. Again, we have an article that's linked or that is on this slide that has more in-depth information on that. And so with that, we are going to jump into our last polling question. I'll turn it over to Amy.
All right, thank you. So our last question is, what COVID-19 legislation would you like more information on? A, employer retention tax credit, B, paid sick and leave credit, C, shuttered venue operator grant, D, all of it, or E, none of it. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And we will be emailing out a copy within 3 weeks should you have difficulty downloading it now. And then also a reminder, if you attended in a group and would like to receive CPE credit, you do need to complete the group attendance sheet that's found in your console. All right, here are the results.
Great, thank you. Okay, so as I kind of expected, most of you want more information on the employee retention tax credit, and I can understand that. There is a lot of nuances with this tax credit. It has changed. FAQs and guidance, it feels like, comes out every month. And, you know, like I mentioned, there's organizations that previously weren't, this wasn't available for them, and it is now. I will say more often than not, we find that this credit is actually more advantageous and applicable than most people think. So definitely something that you want to do some due diligence on and make sure that you're verifying if it could be eligible. And then some of you just want information on all of it. So we're happy to have provided some of that here. And like I mentioned, we've got great content on our website, lots of webinars, and all of that. So with that, just unfortunately due to timing, we don't really have time to get into the Q&As. We do have a lot of you that have written those out. We'll have a list of those, and Emina or myself will get back to you on those. If you have anything that you wanted to ask that you haven't yet, be sure to get that in the Q&A box, or feel free to reach out to Emina or I. Here's our email address and our contact information. And then, like I've mentioned several times, we've got lots of insights and resources and webcasts that are on our website, and we're continually updating that as additional guidance and FAQs come out. So, and with that, I'm going to turn it back over to Amy to wrap it up.
All right, thank you. So thank you, Emina and Colleen, for a really great presentation today. And then just a reminder to our attendees, if you met CPE requirements, your certificate is available to download now in the CPE progress window. I will keep the console open for a few minutes to give you time to download it. And then here is a link to an online survey for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. And thank you for joining our webcast. We hope you'll join us again next time.